What if you could earn money regularly, simply by investing in stocks? Welcome to today's video on how to set up a dividend investment portfolio for steady, passive income. Don't forget to help us out with a like and subscribe to our channel for more of the best passive income content. What if you could earn money regularly, simply by investing in stocks? Sounds too good to be true, right? Well, it's not. Welcome to today's video on how to set up a dividend investment portfolio for steady, passive income. Imagine a future where you receive consistent, reliable income without having to actively work for it. In the next few minutes, I'll show you how dividend investing can help you make that dream a reality. Dividend investing is one of the most reliable and consistent ways to generate passive income. So what exactly is dividend investing? In simple terms, dividend investing means investing in stocks that pay you a portion of their profits on a regular basis, usually quarterly or annually. Instead of having to sell your stocks to make money, dividend stocks provide you with a steady flow of income, typically in the form of cash or additional shares. This means that as you hold onto your investments, you earn regular payouts, helping to build wealth over time. In other words, dividend investing allows you to earn passive income without having to sell your assets. The longer you hold these dividend-paying stocks, the more you benefit from compounding returns. This makes it an ideal strategy for long-term wealth creation, where you build your portfolio slowly but surely over time. Benefits of dividend investing. Now, you might be wondering, why should I invest in dividends? There are several reasons why dividend investing stands out as one of the best passive income strategies available. Let's take a closer look at some of the key benefits. Long-term growth. One of the most powerful aspects of dividend investing is its ability to grow wealth over time. When you invest in companies with a history of steady dividends, you're investing in companies that are stable, reliable, and have a proven track record of growth. Over time, these companies increase the dividends they pay out, often in line with inflation or company growth, which helps your income grow steadily over the years. Regular income. Unlike other forms of investing where you may need to sell assets to realize profits, dividends provide you with regular income. This makes dividend investing particularly appealing for those who want to supplement their monthly earnings or achieve financial independence through consistent cash flow. Many investors use dividends to cover their living expenses or reinvest to fuel further growth. Compounding returns. By reinvesting the dividends you receive back into additional shares of dividend-paying stocks, you can create a compounding effect. The more shares you own, the more dividends you'll earn, and the more those dividends can be reinvested to buy even more shares. This process compounds over time, which accelerates the growth of your investment portfolio, turning small investments into substantial returns. Minimal effort. After setup. Once you've built your dividend portfolio, the work is far from over, but it is minimal. You don't need to constantly monitor or make adjustments unless there's a significant market shift. The beauty of dividend investing is its hands-off nature. You set it up, and over time, your dividends do the work for you. Whether you're a beginner or experienced investor, we'll walk through the key steps: choosing the right dividend-paying stocks, understanding how to diversify your portfolio, and how to reinvest those dividends to maximize growth. By the end of this video, you'll have all the tools you need to build a solid, reliable source of passive income through dividend investing. In addition to selecting the right stocks, we'll also cover the best practices for managing your portfolio and how to ensure that your portfolio continues to provide steady, reliable income over the long term. Ready to get started? Let's dive in and begin building your path to financial freedom with dividend investing. How to choose the right dividend stocks. Dividend yield. Let's start with dividend yield, which is one of the most important metrics when choosing dividend stocks. Dividend yield is a percentage that represents how much money you can earn in dividends relative to the stock price. It's calculated by dividing the dividend per share by the stock price. For example, if a stock pays $4 per share annually in dividends and the stock price is $100, then the dividend yield is 4%. $4, $100 equals 0.04 or 4%. Now, while a higher dividend yield might seem appealing, it's important to be cautious. Typically, a dividend yield of 3 to 6% is considered ideal. This range provides a good balance of income and sustainability. A yield in this range often indicates that the company is generating enough profits to cover the dividend payments while still leaving room for growth. However, high dividend yields, over 6%, can be risky. While they might offer more immediate returns, companies paying these high dividends could be stretching their financials, and the dividends may not be sustainable. In some cases, these companies might even have to reduce their dividend payouts or cancel them entirely if they're unable to generate sufficient profits. So, it's essential to evaluate the stability of these high-yielding stocks. Dividend history. One of the most crucial factors when selecting dividend stocks is the company's dividend history. A consistent track record of paying dividends, especially over many years, is a positive sign. Companies with a strong dividend history are likely to continue paying dividends for the long term, as they've already demonstrated the ability to maintain their payouts through different economic cycles. Look for companies with at least a 5 to 10-year history of stable or growing dividends. Companies that are consistent in paying dividends over long periods are more likely to be reliable in the future. But even better, consider investing in dividend aristocrats, which are companies that have raised their dividends for 25+ consecutive years. These companies are often more stable, and their long-term commitment to raising dividends shows financial strength. Payout ratio. Next, let's talk about the payout ratio. This ratio indicates how much of a company's earnings are being paid out as dividends. It's calculated by dividing the dividend payment by the company's earnings per share, EPS. A payout ratio of 40–60% is considered ideal for most companies. This range ensures that the company is paying out a substantial portion of its profits to shareholders, but still keeping enough earnings to reinvest in growth, pay down debt, and cover unexpected costs. If a company's payout ratio is too high, say above 70%, it could be a red flag. A high payout ratio might indicate that the company is paying out more than it can afford, which could be unsustainable in the long run. When selecting dividend stocks, make sure the company has a healthy payout ratio that allows for continued growth and a sustainable dividend. Company stability and financial health. The next step in selecting dividend stocks is assessing the company's financial health. You want to choose companies with low debt levels, steady earnings, and strong cash flow. A company's ability to pay dividends consistently depends on its financial stability, so ensure the company is well capitalized and able to handle any economic downturns. Companies in stable sectors, such as utilities, consumer staples, and healthcare, tend to offer reliable dividends. These sectors are less sensitive to economic fluctuations and often provide steady revenue. For example, Duke Energy, a utility company, and Procter & Gamble, a consumer goods company, are great examples of companies that not only offer reliable dividends, but are also financially stable and well-established. Diversification across sectors. One of the key strategies when building a dividend portfolio is diversification. You don't want to put all your eggs in one basket. Sector diversification helps protect your portfolio from market volatility. By investing in different industries, you ensure that if one sector faces a downturn, others might perform better, providing a more stable overall return. Consider combining stocks from growth sectors, like technology, with more stable sectors like utilities or healthcare. For example, pairing a growth stock like Microsoft with a dividend-paying utility like Duke Energy balances potential growth with a reliable income stream. A diversified dividend portfolio helps ensure you're not overly reliant on one sector's performance. Building your dividend investment portfolio. Setting your investment goals. The first step in building your dividend investment portfolio is to set your investment goals. You need to decide how much passive income you want to generate each month or year. For example, if you want to earn $1,000 per month in dividends, you need to structure your portfolio accordingly. Let's break this down. If you aim for a 5% dividend yield, you'll need a portfolio of about $240,000 to generate $12,000 per year in dividends. This can seem like a large amount of money to start, but don't let that discourage you. Dividend investing is a long-term strategy, and over time, with reinvestment and regular contributions, you'll build toward that target. Start small if you need to, and focus on growing your portfolio over time. The goal is to set achievable targets and stay consistent with your investment strategy. Initial investment and dollar cost averaging. When you're starting, it's important to remember the concept of dollar cost averaging. This strategy involves investing a fixed amount of money regularly, regardless of market conditions. Whether the market is up or down, you continue investing. This helps smooth out the impact of market volatility and avoids the temptation to time the market, which can be risky. For example, if you invest $500 every month, you will be buying stocks at different price points. During market dips, you'll buy more shares, and during market highs, you'll buy fewer shares. Over time, this approach reduces the risk of making a large investment at an unfavorable time. Selecting dividend stocks for your portfolio. Now that you know your goals and have a strategy, it's time to start selecting stocks for your portfolio. Aim for a mix of high-yield stocks and growth stocks. High-yield stocks provide immediate income, while growth stocks can offer the potential for higher long-term returns. For instance, consider buying stocks from sectors like utilities, consumer staples, healthcare, and financials. You can also look at stocks that offer consistent dividend increases, like the dividend aristocrats mentioned earlier. If you're just starting out, using dividend-focused ETFs or index funds is a great way to diversify your portfolio with minimal effort. Reinvesting dividends. One of the most powerful ways to grow your portfolio is by reinvesting dividends. Many platforms offer dividend reinvestment plans, or DRIPs, which automatically reinvest your dividend payments into more shares of the same stock. This creates a compounding effect, where your dividends generate even more dividends over time. For example, if you receive $50 in dividends from a stock, and that dividend is reinvested, you'll own more shares. As those shares pay dividends, you'll earn more money, which is then reinvested again. Over time, this compounding effect leads to exponential growth in your portfolio. Monitoring your portfolio. Finally, it's important to monitor your portfolio regularly. You don't need to check it every day, but aim to review your portfolio at least annually. Look at how your stocks are performing, evaluate whether they're meeting your income goals, and check the dividend payout ratios and dividend history to ensure the sustainability of the income. If you notice a stock reducing or cutting its dividend, consider replacing it with a more reliable option. Additionally, rebalance your portfolio every year. If certain stocks have appreciated significantly and others haven't performed as well, you may want to sell some of the underperforming stocks and buy more of the higher-yielding or stable stocks. Example, portfolio and simulation. Example of a beginner dividend portfolio. Let's put everything we've discussed into action by creating an example portfolio for a beginner dividend investor. A diversified portfolio with a mix of stable dividend payers across different sectors is key for reducing risk and ensuring reliable income. Here's an example portfolio. Utilities, Duke Energy or Southern Company. These companies are known for their stable earnings and consistent dividend payments. The utility sector is typically less volatile, making it a good choice for steady income. Consumer staples, Coca-Cola and Procter & Gamble. These companies have a long history of dividend payments and are part of the dividend aristocrats. The consumer staples sector provides essential products that people buy regardless of the economy, ensuring steady sales and reliable dividends. Healthcare, Johnson & Johnson or Pfizer. The healthcare sector is often recession-resistant, and companies in this space often pay strong, consistent dividends. These are also companies with a long history of increasing dividends. Technology, Microsoft or Apple. While technology stocks may not traditionally be thought of as dividend-heavy, these companies offer reliable dividends along with significant growth potential. These companies are proven to be financially stable, with room for both growth and consistent dividend payments. Building a balanced portfolio for $1,000 a month. Now let's break down how you can structure your portfolio to reach your goal of earning $1,000 per month in dividends. For simplicity, let's assume you're aiming for a 5% average dividend yield across your portfolio. To make $1,000 per month, you'll need $12,000 in dividend income per year. $1,000 in 12 months. With a 5% dividend yield, you'd need to invest $240,000 to generate that amount of income. $12,000 divided by 0.05 equals $240,000. Here's how you could allocate that $240,000 across the sectors. $60,000 in utilities, 25%, with a yield of 4% equals $2,400 in annual dividend income. $60,000 in consumer staples, 25%, with a yield of 3.5% equals $2,100 in annual dividend income. $60,000 in healthcare, 25%, with a yield of 3.8% equals $2,280 in annual dividend income. $60,000 in technology, 25%, with a yield of 1.5%, equals $900 in annual dividend income. In total, this diversified portfolio would generate around $7,680 per year, or about $640 per month. To hit your target of $1,000 per month, you would gradually increase your investments and add higher-yielding stocks, or reinvest your dividends for compounding growth. In conclusion, let's recap the key points. Today, we've covered how to set up a dividend investment portfolio that generates steady passive income. The key takeaways are: choose reliable, stable dividend-paying stocks. Diversify across sectors to reduce risk. Focus on long-term growth and reinvest your dividends. Consider tax-efficient strategies to maximize your income. Regularly monitor and adjust your portfolio to ensure you're staying on track. Final encouragement: dividend investing is a long-term strategy, but the payoff is worth it. With patience and consistency, you'll see your portfolio grow, generating a steady stream of income over time. If you're ready to start building your dividend investment portfolio, don't forget to like this video, subscribe for more financial tips, and share this with anyone looking to earn passive income.